Good evening to all of you, friends, and thank you for sparing your valuable time for this session. So, let me briefly share with you some thoughts around the Indian economy, and then I'll go on to discuss the prospects for the profit growth, and finally, around valuations and some thoughts as to what are the variables or the risks that we should be aware of. So I think clearly the external environment for India has sobered a bit because oil prices have gone up very sharply. FIs have continued to sell into India, and I think they're selling over last year and this year. YTD is closer to 60 billion, 30 billion US. Uh, US interest rates have gone up quite sharply. They are very close to 3.5% now. So the external side has become slightly challenging, and this will put some pressure on balance of payments in India, and the sharp rise in commodity prices, both energy and to a lower extent in India food, I think will also add to some inflationary pressures. The economy is recovering reasonably well from post COVID, post lockdown, but I must add that section of the households uh, have not recovered fully. So, a reasonable part of India households are employed in small and medium enterprises and in services, and the contact services have not recovered fully. The SMEs also are not doing that well. Uh, the inflation in food and energy is quite a large part of the average household budget, the low income households. So, the low income households in India are experiencing some pressure. And this is showing up in moderate growth in consumption. The especially the products that are bought by the low income households are not experiencing that robust a demand. For example, the two wheelers are not experiencing that much growth. The high end cars, the expensive cars are growing extremely well. So the point I'm trying to make is that post COVID, while economy on an aggregate total basis pay it's doing quite well, but the low income households, many of them are still in some pain. The so net, if you look ahead, the outlook for economy is I think steady in the near term, and over time, I think the economic growth in India has potential to accelerate meaningfully. We have a good demographics. Our India's working age population will cross China. China is already beginning to experience a fall in working age population. So I think the manufacturing is likely to shift towards India. That's a very large opportunity for India, and we have spoken on this for last few years. So manufacturing in India is indeed becoming quite competitive. The bank balance sheets, companies' balance sheets are very healthy. The NPA cycle is behind us. Corporate debt equity, corporate leverage is near 10 to 15-year low. Corporate profitability has come back very strongly. So in manufacturing, almost all segments, whether it is chemicals, paper, sugar, textiles, metals, all are doing quite well. So the corporate and bank balance sheets are quite healthy. And there are reasonable signs now of a revival in private capex. If you look at the order backlogs, order inflow of engineering companies, construction companies, I think the order inflows have been quite good, and therefore I believe that apart from infra capex, which is continuing, I think industrial capex, private capex is also reviving quite nicely. So net, I think Indian economy is quite well placed. We may see some moderate consumption growth because of the reasons I mentioned, but exports, capex, these parts of the economy should ensure good growth in the near term. And of course, over time, consumption growth will India in India will also recover as we open up fully, as small and medium enterprises come back to normalcy, as the service sectors regains complete normalcy. Uh, in fact, if you think the next 10 years, it is the very good. The picture is extremely positive for India. By the India should be the fastest growing economy in this decade. I think by a reasonable margin compared to any other large economy in the world. India should also emerge as the fifth largest economy before the end of the current decade. In the last 2 years, we have carried out some good reforms. GST, as you know, in India has clearly stabilized now, and India is now one large market, and that is bringing efficiencies in many ways. Our ease of doing business rankings have continued to improve. The PSU divestment, which is a big initiative by the government, as still continues to be work in progress. We have seen some small successes. I think Pawan Hans has been done, Air India has been done, and I think RVNL or RINL also has been done. But the big ticket divestments are still work in progress, and there have been some delays there. But I think the government is committed, and hopefully over time we will achieve greater progress there. There is a big focus on Make in India. There is a big focus on indigenization, and the PLI scheme, the negative list of imports. I think all are part of this initiative, and I think the environment is very conducive for India to improve its share of global manufacturing because we have gained cost competitiveness over China. The buyers are very keen to de-risk because of the experience during lockdown in China, the supply chains were disrupted. And the government of India is very supportive of increasing India's share of global manufacturing, both for our own needs and also for exports. So net, I think despite the some pain which low-income households are experiencing, the somewhat moderate consumption growth likely in the current year, I think supported by private infra capex and exports in the current year, and even consumption doing well next year onwards, I think the medium to long-term growth outlook for India is quite strong. Some people feel that the improving rising interest rates, rising inflation will not be good for profitability of companies. So let me take some time to explain why the impact on profits of current economic conditions is likely to be extremely or very marginal. If you look at the profit pool of Nifty, if whatever is Nifty's total profits, if you break that up across sectors, roughly a third of the profits are coming from banks. Now, today the bank's loan book is such that roughly two-thirds of the loans are floating. What that means is the moment interest rates start going up, these loans will get repriced. The moment repo rate goes up, some loans get repriced. So in this cycle, because this was not happening earlier, the floating rate loans is the highest today of Indian banks' balance sheet, and therefore the loans will reprice faster than the deposits. So higher inflation, which in turn is leading to higher interest rates, is actually going to aid the margins profitability of banks. Also, higher inflation is leading to faster credit growth because working capital cycles, working capital needs have increased. So we are experiencing double-digit credit growth, like we are expecting double-digit credit growth in the economy this year. State Bank chairman has said in a number of media interactions that he expects meaningful improvement in credit growth this year. So I think banks should see a good increase in loan books, and because of the composition of asset side, the margin should also hold up quite well. And finally, the NPAs in banks, as we know, are extremely low, so the provisioning costs going forward should not be material. So that is one third of the Nifty for you, where higher interest rates and which is led by inflation are actually good for the profits of this part of the markets. The next, roughly one fourth to one third of the profits are coming from commodity linked businesses, whether this is oil and gas, whether it is coal, whether it is refining, whether it is metals. So all these add up to roughly one fourth to one third of the markets. And as we know, oil prices are high, gas prices are high, coal prices are high, metal prices are high, and so are refining margins. Refining margins are also extremely high. So inflation and higher commodity prices go hand in hand. And to that extent, this profit pool is also unlikely to be adversely impacted. In fact, if at all, there is a risk of some of these commodity prices coming down, and that can impact adversely the profit growth of this space. But for now, at least, the outlook is quite decent. About 15% of Nifty is in software services. About 5% is in pharmaceuticals. So these 20% of the markets roughly benefits from any depreciation in the currency, which is likely uh, because of the pressure on balance of payments given the elevated oil prices and the FII outflows. The US economy also is in very good shape. Wage inflation in US is extremely high, which will encourage them to outsource more, and the need for businesses to adapt to the digital world is extremely urgent. And India has virtually no competition in the world as a destination for software services. So I think the outlook on this space also continues to be quite reasonable. The weight of the consumer oriented sectors, the profits or the market weights is roughly about 15%. And this is the part of the market or profits which may see some softness due to higher commodity prices or lower demand conditions. But the point I'm trying to make is that bulk of the markets, roughly three-fourths of the markets, the profit growth outlook appears to be quite reasonable. Uh, I must also add here that over the last 2 to 3 years, we have seen a very high profit growth because India's profits to GDP ratio had fallen to almost 1.6%, and which was extremely low because of the challenges being faced by banks in India due to NPAs, by low commodity prices and weak capex. I think all of that is normalizing. Banks don't have NPA provisioning costs now, commodity prices are high, and capex is recovering quite well. So profits to GDP of India are closer to 4% now, which is a reasonable level. So going forward, we should expect profit growth in line with nominal GDP growth rates, and that catch up in profitability from very low levels is now behind us, probably. So what I have said so far is that despite some challenges on the external front, like high oil prices, which are putting pressure on balance of payments, creating some inflationary pressures, and also leading to higher interest rates, the outlook for India's economy and profit growth continues to be quite steady. Uh, in case, some of you are still skeptical, let me share with you that in the past, Indian interest rates have been as high as they are today. The US interest rates have been actually higher, and India has done quite well in these periods of even higher interest rates. So what we are experiencing of higher inflation, of higher interest rates, is a normalization process of abnormally low interest rates over last few years. And I think this had to happen. And I think the capital markets have been aware. We have discussed this in our yearbooks. We have been discussing this in many conferences, etc. also. So I think what is happening is probably not surprising directionally. But of course, the trajectory, the sharp pace at which US yields have moved up have probably taken people by surprise. But I don't think that should impact India's economy materially, because Indian interest rates did not even fall as much as they fell in the Western world. And so even the normalization process should be quite, it should have less impact here. The coming to valuations, and last 1 year now, if you look back, the markets have been range bound. In fact, last 1 year returns are practically zero. I think not just 1 year, probably 15 to 18 months returns are extremely low. So we have had this 1 to 1.5 year period of time correction. And in this period, the because of real growth and because of higher inflation, India's nominal GDP growth has been quite healthy. So market cap to GDP, which was at the top end of the past of the valuation range, is now coming closer to the lower end. And because this is a reasonable time correction that we have experienced, so markets are now looking more reasonably valued than what they were 6 or 9 months back. And we are beginning to see the emergence of value in the markets. If you look at fiscal 24, and in about 3 months' time, by the time we are in September, so we are almost there, markets will start factoring in fiscal 24. Based on that, India's market cap to GDP, I think, should be around 85, 88%. Our P multiples should be around 16 odd times, which I think are reasonable valuation levels. 1 year from today, the markets will move, or maybe even 6, 9 months from today, the markets would have moved to fiscal 25, because fiscal 23 would have practically ended. And based on that, India's market cap to GDP should be below 80%, and our PE multiple should be closer to 14 odd times. And these are certainly attractive multiples to target decent long-term returns. So the point here, what I am trying to make, is a very simple one, that markets in India have seen some price and slightly more time correction. And the combination of these two has created multiples which are more attractive than where we were 6, 9 months back. And as we go into this year, as we come to fiscal 24, and after maybe 9 odd months to fiscal 25, I think the valuations will start looking even more attractive. So the risk reward of Indian markets has certainly improved given this time and price corrections. Now, what are the variables that we need to take, that we need to monitor? I think the next 6 months, one way or the other, should price in most of the uncertainty around the US interest rates, around oil prices, around what is happening in Ukraine, and even FII flows. So these are 3 or 4 key variables. How do FII flows behave? Where do oil prices stabilize? When is there a ceasefire in Ukraine, and what is the direction, or where do US interest rates start stabilizing? I think by and large, we should get answers to all of these in the next 6 months. FIs have sold in India almost 1% of India's market cap, which is close to all-time high selling, except the Lehman year. But then that was a very unusual year, and we are not in that kind of a situation at all. So considerable FI selling has already taken place, and while no one knows exactly, but I do think it is reasonable to expect that this selling should abate in the next 1 to 2 quarters. It could happen even earlier, given the extent of selling that has taken place. The Ukraine war, while again no one has a clear view, but I think this level of hostilities, I find it very hard to believe can continue for too long. So, whatever the outcome, I think this war-like situation should ease or cease in the next 1 to 2 quarters, and it would be interesting to see how oil prices behave after that. And meanwhile, oil prices that have also gone up very sharply. Uh, 6 months from today, they would have priced in a full recovery post opening up, especially in China. The hopefully shale oil production in US would start seeing improvements, and hopefully some solution will also be found to the supplies out of Russia. So wherever they have to stabilize, I think in the next 6 months we should also get some answers there. And finally, US interest rates. The high inflation in US, I think markets expect the Fed to accelerate the rate hikes. And I think in the next 6 9 months, broadly, we should have a fairly good sense of where interest rates in US should also stabilize. And we need to bear in mind that US interest rates have already gone up from 1% to 3.5%. So it's been a very sharp move in US. So I think I am tempted to say that bulk of the yield increase in US is probably behind us. It could still go up more, but I think the pace and extent of future increase in yields will be less compared to what we have seen in the past. So I think these next 3 6 months are still there is some uncertainty, but by the end of this period, most of these issues should be resolved. So what should be our strategy in these kind of conditions? I think one, we always say that equities are your risk capital. Invest only that much in equities which you can hold for long periods of time, 3 5 year views, where you can be tolerant to volatility. Apart from within that asset allocation, I think it would make sense to start slightly increasing our exposures to equity because of the reasonable time and price correction that we have experienced. We should invest in the markets in phases over the next 6 months. If there are any sharp dips, we could take advantage of that. So I think the next few months or quarters offer a good opportunity for the long-term investor to buy Indian equities at at reasonable values, and where most of the uncertainties seem to be priced in. I think the final, a variable which we don't know, but we can keep track of is the FII outflows. Should FII outflows reduce, or should they become zero or turn positive? I think that could have a very significant impact on the markets in the near term. Because as we know, unlike on the past occasions when FII selling used to take place, markets used to fall very sharply. And I always said that the best opportunities to invest in Indian markets are around times when FIIs are large sellers. This time around, because of the large local flows, which is actually extremely welcome, because that tells us that equities are becoming a core asset class and not a seasonal asset class anymore. And uh, uh, how this has reduced the impact of FII selling on Indian markets. So I think, given the fact that so much of selling has already been absorbed, if this selling was to reduce, I think, though no one knows for sure in equity short term, but it is possible that markets may actually experience uh, sharp bounce back should FII flows turn positive or should the selling stop. And so, net, what I am saying is that markets are always volatile, no matter how much research we do. The near term in equities is always uncertain, and these are also similar times. We know the variables, three, four variables that I mentioned, but how they change over next 6 months, we don't know. But I think there is a good chance that these will settle down in next 6 months. So we should use this period of next 6 months to get to our target asset allocation in equities. Some thoughts around sectors, because I am sure there will be some uh, questions around that. So I feel the consumer space in India continues to be expensive. It has derated somewhat, but I still think it is quite expensive. The rising commodity prices, the pressure on low income household budgets due to sharp increase in food and energy prices, the uh, no, in the past, this sector has benefited from cut in corporate tax rates and GST rates. I don't think any such concessions are likely. The rising cost of capital, which is adverse for secular growth, high P businesses more than others, and the profit growth, which is quite broad based. See, few years back, profit growth was being experienced by limited number of sectors, and therefore there was a premium market was willing to pay for those sectors, and consumer was one of them. Now almost every sector is doing well in terms of profit growth, whether it is banks, software, pharmaceuticals, metals, capital goods, consumer, utilities. Profit growth is quite broad based. So I think that premium for profit growth should reduce. So I think this is one space where P multiples, even after the correction, I think they continue to be quite high. And I think the P multiples are closer to fair levels in sectors like IT. They have corrected somewhat. The payout ratios in this sector have gone up. So I think there is some value in this sector. And as we all know, this is a very competitive, high quality growing sector. So I think there is the P multiples are a lot more reasonable now than what they were some time back. The capital goods companies are expensive in terms of PE multiples, but the growth outlook is quite robust. And I feel that this sector may sustain these high multiples because when the cycle turns in capital spending, the profit growth can be quite high and margins also tend to expand. The banks, which is the largest component of the markets, the multiples are now below longer term averages because this sector has borne uh, most of the brunt of maximum FII selling. It was the biggest owned sector by FIIs. So I think the bank balance sheets, the bank outlook, growth outlook is quite good, and multiples are quite reasonable. And this sector has derated quite a bit, and this is the largest sector in the markets. So that is again offering reasonable value. The sectors which are still uh, available at below fair multiples, I think, continues to be the power space. This has done quite well in recent times, but still, I think there is some room for multiples to improve, though clearly, given the re rating that has taken place, that room has substantially reduced. So by and large, I mean, I would say most sectors are trading around fair multiples. There is some room for multiples to go up in the power and the banking space, in my judgment. And I feel the consumer space continues to be uh, uh, trading at above reasonable multiples. Uh, Between large, mid, and small caps, I think most of the correction has taken place in the small mid cap space. And when market conditions are tough, the excesses tend to get corrected very fast. And that is what we have seen in some of the new age businesses, in some of the businesses with weaker fundamentals, in some of the very richly valued businesses. Correction has been far more than in sectors that were trading at reasonable multiples that are strong and or are large cap. So Nifty has broadly corrected a lot less than some of these pockets of excessive valuations or weak fundamentals. So I would say that given that we are still not out of completely out of uncertainty, and the since most of the selling has taken place in large caps by foreigners because that is where the liquidity is, my preference would be to, at least in the first round, we should prefer large caps over small and mid caps. In the small and mid cap space, I mean, I feel, though there is very little data to support this, that not a lot of stocks have changed hands. And I think that process could take a while longer because of the limited liquidity. So I think our preference, at least in initial round, should be for large cap, multi cap kind of funds. And over time, one can look at the other spaces as well.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.